When a business changes the way in which an item's value is calculated for inclusion in the financial statements, we have to consider whether that change results from a change in accounting estimate or whether it relates to a change in accounting policy. A company's accounting policies are the specific set of rules and principles and guidelines that they apply in the preparation and presentation of their financial statements. The accounting policies normally originate from accounting standards and gives guidance in how specific items and events and transactions should be accounted for in the financial records. However, not all items have an exact value for inclusion in the financial statements, and in those cases we rely on the accounting estimates made by management to value the items for inclusion in the financial statements. Because accounting estimates is dependent on a person's judgment, it is not surprisingly that companies change their accounting estimates as new information becomes available. Let's look now at an example of a company that changed the way in which they calculated their allowance for doubtful debts, in order to consider whether it represents a change in accounting estimate or whether it's a change in accounting policy. Mouse Deer Limited traditionally estimated their allowance for doubtful debts as a percentage of net credit sales for the year. When the accountant analyzed the variance between the amount that was raised as an allowance annually and the actual bad debt written off, they saw that there were a significant unfavorable discrepancy between the two values. Therefore, a change was made in the method of estimation by changing it from a percentage of net credit sales to an analysis of the accounts receivable balance. If this change in calculation is a change in accounting policy, that change needs to be applied retrospectively. This means that comparative figures need to be adjusted as far back possible as is practical. In this example, the asset is accounts receivable, a financial asset which is measured at the lower of nominal value or recoverable amount, where the recoverable amount is the nominal value of the debtor adjusted for a potential doubtful debt allowance. If we look at the information available, we see that the basis of measurement stays the same, even though we change the way that our doubtful debt allowance is calculated. The asset, being accounts receivable, is still going to be measured at the lower of nominal value and the recoverable amount. The recoverable amount's just going to be calculated differently. So the accounting policy stays the same. Accounting policies normally only change when there's a change in the accounting standard relating to that policy, or where management's convinced that the change will improve the reliability or relevance of the information that's reported to the users. This example is therefore a change in accounting estimate, and this means that the change has to be applied prospectively in this year and in future years if necessary. The change in the way that management estimates what the recoverable amount is does not change the measurement basis, and therefore this example is not a change in accounting policy.